Many investors evaluate asset performance by looking at one full history average, assuming the market is a stable, unbroken sequence. Markets do not reward the same financial exposures in every environment. Collapsing a backtest into a single average creates a fatal blind spot. It treats a high-growth, risk-on Goldilocks market as if it presents the exact same allocation problem as a stagnant, risk-off inflation environment. Relying on these blended returns masks the severe volatility required to earn them. When the macro regime shifts, portfolios built on these averages are left exposed. To measure how assets actually behave, the Logic Backtest Analyzer evaluates 52 specific investments, grouped into currencies, fixed income, equities, and commodities. We separate 15 years of market history into 8 distinct combinations of macro environments and risk regimes. This scatter plot maps risk versus return. In the risk-on Goldilocks regime, Bitcoin generated the highest monthly return at nearly 8%, but capturing it required absorbing volatility above 21%. Evaluating return to volatility, Treasury bills were the most efficient asset. A high return number is frequently just compensation for accepting wider price swings. A resilient portfolio requires specific engines to generate growth and entirely different stabilizers to manage risk. Shifting to a risk-off inflation regime, previous market leadership collapses. Formerly dominant assets, including Bitcoin and communications equities, fall into deeply negative returns. Meanwhile, new stabilizers emerge. Uranium delivers the strongest risk-adjusted commodity return, and healthcare leads equities. Sector behavior diverges sharply depending on the macro backdrop. A generic directive to buy equities lacks the precision required when tech leads in one environment and industrials lead in another. Throughout these rotations, defensive exposures like the US dollar and Treasury bills top their risk-adjusted categories in the majority of the 8 environments. Asset allocation cannot rely on picking a static set of tickers. You must match your exposures directly to the prevailing macro conditions. Historical averages are descriptive, not forecasts. But macro shifts are bound by mathematical necessity and follow testable, data-driven paths. The workflow is straightforward. Check the monthly macro map to identify the current logic macro regime and frame the likely path over the next 6 months. Use this framework to test how different asset classes behaved historically and adjust your portfolio's risk-adjusted exposures before the environment turns. Institutional positioning requires visible evidence. Let the data map your next move and leave the market narratives behind.